All right, we're going to jump in a time machine today. Destination 1978. Why? Because we're cracking open a playbook from one of the world's greatest investors, written decades ago. And the big question is, can those words still hold the secrets to success today? Let's dig in and find out.
Okay, so picture this. You're reading a company's annual report, and you come across this line. The person writing it is describing their own financial statements. So who do you think says something like that? I mean, a disgruntled employee, maybe? A whistleblower about to drop a bombshell? Nope, get this. It was the chairman himself, Warren Buffett. Right there in his 1978 letter, he basically tells shareholders, hey, these official numbers that follow all the rules, they're actually kind of confusing. And that, right there, sets up the entire playbook we're about to explore. His relentless search for what's really going on, not just what the accounting rules say is going on.
So first up, seeing through the numbers. Buffett's core idea was that before you can even think about evaluating a business, you've got to cut through all the noise and all the jargon to see it clearly.
The big problem back in 1978 was this rule called full consolidation. Because of a merger, Berkshire was forced to just lump everything together. We're talking textiles, insurance, See's candies, newspapers, all into one giant messy report. It made it basically impossible to see what was truly driving the business. And, that's a timeless lesson, right? Even today, really complex financial reports can hide more than they actually reveal. So what did he do? Well, his approach was just brilliantly simple. He essentially told shareholders to ignore the official combined numbers. First, look past that consolidated mess. Second, break the company down and look at each piece on its own. And third, and this is the key, focus only on the real underlying earning power of each individual part. And this leads us right into Section 2, Anatomy of a Business. Because once Buffett could see each part clearly, he could really diagnose which businesses were healthy, and frankly, which ones were sick. And boy, does this illustrate the difference. It's like night and day. On one side, you have the old legacy textile business. It had low margins, it soaked up tons of cash, fierce competition. Buffett just called the returns inadequate. But then on the other side, you had the insurance business. It was gushing profits, had fantastic leadership, and was the #1 reason for Berkshire's success. The rewards there, he said, could be exceptional.
And if you want to see what he meant, just look at this chart. It tells you the whole story. Where was the money really coming from? Look at that. The huge majority of earnings came from investment income and those high-quality insurance and banking businesses. All the other stuff combined, it barely even moved the needle. This is what you see when you actually look through the numbers.
And just to prove that not everything was a home run, here's the pre-tax loss from the Buffalo Evening News that year, nearly $3 million. It's a powerful reminder that even the best investors have ventures that struggle. The crucial point is having enough truly great businesses to carry the weight of the difficult ones. Now, this deep understanding of business quality led directly to his investment philosophy, and that's Section 3, the market's great bargains. How did he take all this thinking and apply it to the stock market? Well, first, just look at this explosive growth. Between 75 and 78, the value of Berkshire's stock portfolio just skyrocketed, from just under $40 million to over $216 million. That's a massive increase. But you know what? That's not even the most amazing part. He pulled off that incredible 450% growth during a time when the overall stock market, the Dow Jones Average, actually fell. Just think about that for a second. While most people were losing money or just sitting on the sidelines, Buffett was out there finding incredible bargains. And this fact right here is just stunning. In 1978, the so-called experts, the people managing the big pension funds, had a record low 9% of their money in stocks. They were terrified. But Buffett saw all that fear not as a risk, but as a massive opportunity. It was a giant green light to make smart, concentrated bets while everyone else was panicking. So what did one of these bargains actually look like? Well, let's look at a textbook example from his portfolio at the time, Safeco Insurance. And here it is, straight from the man himself. He saw that corporations were paying huge premiums to buy mediocre companies outright. But meanwhile, in the stock market, he could buy a piece of Safeco, what he called the best company in the business, for less than it was actually worth. I mean, it was an absolute steal. And his logic for buying just a piece was just brilliantly simple. Why deal with all the headaches of running an entire company when you can buy a stake at a bargain price and let the best managers in the world do all the hard work for you? And that brings us to the final and, maybe the most important piece of the whole puzzle. Section 4, Betting on the Manager. For Buffett, business was never just about the numbers. It was always about the people.
Just take a look at the ages of some of his top managers back in '78. Gene Abegg at 81, Ben Rosner at 75, Louis Vincenti at 73. At a time when most companies were pushing people toward retirement, Buffett was entrusting his capital to seasoned leaders with decades of experience and a deep, deep love for their work.
This quote says it all. He wasn't looking for MBAs with fancy spreadsheets. He was looking for people who thought like owners, people who were passionate, who were skilled, and who treated the company's money like it was their very own. So, let's bring it all home. After all this, what are the enduring lessons we can pull from this 1978 playbook? Well, it turns out the 1978 playbook is just as powerful today. It really boils down to this: always seek the economic reality, not just the accounting fiction. Own great businesses, or even just pieces of them. Remember that the market's mood is your opportunity. Let competent, honest people do their jobs. And finally, when you find a great idea, bet with conviction.
And that leaves us with one final thought to chew on. In today's world of algorithms, meme stocks, and a 24-hour news cycle, is it possible that the single biggest market inefficiency, the greatest bargain of all, is simply the patience to think for the long term? Definitely something to consider.